Good afternoon and good morning, depending on where you are signing in from. My name is Larissa Green. I'm with Advanta IRA, and we will be talking in just a moment with Jonathan Leader from Excelsior Capital. He's going to give us some information on how commercial office investments have sort of changed. I mean, they really have, of course, changed with the pandemic and everything we've been through this year, but he's going to explain how there was a trend really before the beginning of this year and everything happened and how it will continue. So it's going to be great information for you guys on different types of investments you're considering, and especially with commercial office, because I think we've seen a lot of changes. I think we'll continue to see a lot of changes, so it'll be good information for you to have. Again, my name is Larissa Green. I'm with Advanta IRA, and I'm going to give you some background on self-directed retirement accounts before we jump in and bring Jonathan in to give us information and also answer your questions. So before I forget, and as we move on, I just want to let everybody know that you are welcome to ask questions. As a matter of fact, we would encourage you to do so, but we do keep everybody muted on the webinar because we are recording this and we like to share our webinars, and it just makes for a good, clean recording. So the way that you can ask a question is go ahead and type it into the question box there. I will be monitoring questions and taking them throughout the presentation. So here's my information here, and I've been with Advanta IRA since 2011, so a little over 9 years now. I'm going to be hitting the double digits and really aging myself there soon. But what I do for Advanta is business development and education. So a lot of you may know me. I have done a lot of presentations for Advanta over the past 9 years. I also do a lot of networking, and so maybe we've seen each other out and about. I'm so glad that you could join us today. Here's my contact information in case you guys have questions. So today's presentation is really going to be focused on commercial real estate and the information that Jonathan has to share with us. But we also do educational events all the time, and we teach on the rules for self-directing your IRA and talk about the different investment strategies we see. So I would encourage you guys to join us for that. A little disclaimer for you guys, although we talk a lot about the rules and investment strategies with self-directed retirement accounts, what we can't do is provide you with investment, legal, or tax advice. So just keep in mind that if you're considering any type of investment, that you're doing your due diligence and you're consulting those professionals that can help you guys really analyze the investments and answer your questions there. If you don't have somebody that can help you in those fields, please let me know. I'd be happy to find a referral for you. Our clients have given us a lot of good resources over the many years that we have been in business, and I'd be happy to share those resources with you. So just a little bit about Advanta IRA. We are a self-directed IRA firm. If you're not familiar with what that means, basically we help people who want to invest outside of the market. We don't sell any investments at all. What we do instead is hold the account and allow our clients to find those investments that they feel are a good fit for their retirement account. And what we like to say about self-directed IRAs is that, the growth of your account is really up to you. How it grows and what investments you make are going to be completely your own strategy. And so we help hold the account, you find the investment, and then we help you get it done in the name of the retirement account. So we're really not competing with brokerage firms. We just fill the gap in the industry for those investments that are outside of the market. So we don't hold anything market-based at all. We hold only private investments, and I'll talk about what that sort of looks like in just a second. But we've been holding presentations and helping clients with these types of accounts for almost 20 years now. And we have 2 offices. I'm actually in Clearwater, but our office is in Largo, Florida, the Tampa Bay area of Florida, if you're not familiar. And we also have an office in Atlanta, Georgia, but we can help anybody nationwide. And so our clients are spread all over the US, and we also have clients outside of the US, because very simply, if you have a US-based retirement account, you can self-direct it and we can help you do that. So that's sort of a little bit about us. For those of you that do have a self-directed account with Advanta, you know that you are going to have personalized service with your account manager. Your dedicated account manager is there to help you with anything from making contributions all the way through to making investments for the life of your account. So that's sort of what makes us stand out from our competitors. So what is a self-directed retirement account? Well, It does mean something very specific to us, because I know that out there brokerage firms do offer a self-directed option where you can make investments that you choose, but of course those investments are going to be market-based. So again, our definition is much different than that, where we're holding only private investments. And so here's sort of a little list that I put together of investments that you will see in a self-directed account. And the reason that I mention it's sort of the short list there is that the IRS actually does not give us a definitive list of investments that we can make or choose from when it comes to retirement accounts. I think that people always sort of find that interesting because they say, well, this must be new. I never heard of it. You know, nobody told me about it. I asked my CPA, they didn't have any idea about it. So how long has it been offered or available? And the truth is, it's always been available. And it's just that there are not a lot of companies out there like Advanta IRA that will hold these private investments. Brokerage firms typically consider these assets hard to value. They don't know how to, nor do they want to be involved with things like, you know, private equities and private stock, where they're just not sure how to value or sell those assets. They also don't want to be involved in accepting mortgage payments on behalf of an IRA, for example, or maybe even paying a mortgage on behalf of an IRA. So that's really what we specialize in. And so just to give you an idea of what it is that we see at Advanta on a regular basis, real estate, of course, in many, many forms, and I have a few of those listed here as well, but private equities, for example, and syndications. We see real estate in the form of note and mortgages, and it can be commercial real estate, it can be residential real estate. We see a lot of things like buy and hold real estate, whether it be, you know, single family homes, mobile home parks, multifamily, again, syndications and things of that nature. So there's a lot of that at Advanta. It makes up for about 30% of the assets we hold. And I know that that doesn't seem like a lot, but that is actually the largest percentage of assets that we hold at Advanta IRA. So it makes up for a good portion of that. I also have on here precious metals, and of course we've seen an uptick in that since the beginning of the year. And, you know, I do feel precious metals are sort of what we'll see in waves. So we'll see a lot of it now, and maybe it'll sort of even off towards the end of the year, and we'll just have to wait and see, but it is something that we're seeing more of lately. Foreign currency exchange and something even like cryptocurrencies and future tradings, and there's futures trading, and there's so many things that you can do with a self-directed account. So typically, I will have people call me at least once a month with a new investment idea for their IRA to find out if it's something that we can hold. And it never seems to amaze me what the entrepreneurial spirit of our clients and contacts will come up with for investments. So that just sort of is giving you an idea of what we see on a regular basis. Again, if you haven't heard of self-directed IRAs, it's just very simply, you know, the best kept secret apparently, because many people don't know that they do not have to invest inside the market, that they can take control. And, you know, less than 4% of all retirement accounts, including things like 401ks and pension plans, are truly self-directed. And so that just gives you an idea of how many people really just don't know about all of the things they can do with a retirement account. So I'm going to just give you guys really quickly an overview of the accounts, and then we'll move on and have Jonathan explain to us what trends he's seeing in commercial real estate. So, of course, traditional and Roth IRAs, those are the most common investment accounts for retirement, and just very simply the reason is because just about everybody has access to these accounts for making contributions. Also, traditional IRAs typically are rolled over from old employers' plans. So if you've left a job at any point, you know that you can take your 401k, and you have a lot of options there, but one of them is to roll it into a traditional IRA. When you have a pre-tax account, which typically 401ks are, they'll go seamlessly into a traditional IRA, so no taxes or penalties are paid. A Roth IRA is the tax-free account. It's a great account. We actually dedicate webinars specifically to things like Roth conversions so that you can understand the ins and outs of these types of accounts. We have employer-based plans, SEP IRAs and simple IRAs, like I said, any former employer plan. And then we also offer solo 401ks. HSAs, which of course right now we're sort of headed towards open enrollment, and we'll see an uptick in interest for HSAs as well, and then education savings accounts. If you guys are interested in learning more about these types of accounts, just let me know. But my partner Alex did just do a great webinar on health savings accounts. And so if you've considered a health savings account but you need to learn more about it, I definitely recommend going to our YouTube channel and checking out the health savings account webinar with Alex Perney. It will be the most recent one posted, I believe. But anyway, you can go to YouTube and just search Advanta IRA and you'll find that information there. Most people choose to invest just very simply because it's a new source of capital to them. As I mentioned, there are not a lot of retirement accounts out there that are self-directed, and most of the time, retirement accounts tend to be the most liquid way for people to invest. So when you have a new investment opportunity, you can turn to your IRA and say, okay, I want to sell off the stock or mutual funds that you might be invested in, and now you have that capital to make those investments that you want to make. Stock market fatigue, of course, we're seeing a lot of that now in this year. We had an interesting start to the year, and the stock market continues to feel the effects of the pandemic, and of course the uncertainty and all of the things that sort of follow with that. So very simply, people want to either get out of the market completely or truly diversify. So making those private investments and having the ability to say this asset is not directly tied to the market. And then, of course, tax benefits, investing tax deferred or tax free is always a win-win. And so those are just some of the reasons that we see people self-direct. I'm going to introduce Jonathan for you now. And I just want to remind those people that are on, you are welcome to ask questions at any time. I will be monitoring the question box, so I would encourage you to do so. And Jonathan, how are you doing today?
Doing very well. I think I might have been up a little later than most last night, taking in the returns, but I'm doing well. Feel good.
Great. Thank you so much for joining us. And I have some information here on Jonathan's background. But Jonathan, why don't you give us just a quick overview of who you are and the information that you're going to share with us today.
Absolutely. And just to kind of comment on your remarks, I think it's amazing how individuals are starting to kind of wake up to the power of their qualified dollars. I think for so long, there's been a Wall Street kind of big bank, big custodian narrative that retirement accounts were only for kind of long only stocks and bonds and mutual funds. And, the fact that investors and high net worth individuals can utilize their IRAs, retirement dollars, set up self-directed IRAs through groups like Advanta is just so powerful to be able to kind of participate in the alternatives and private equity offerings that you mentioned. And I think that's a story that is only going to take more shape and get bigger as more and more people kind of wake up to the optionality of their self-directed IRA. So thank you for doing what you do is what I'm saying. That said, I work for Excelsior Capital. We are a commercial real estate firm in Nashville. We are a pure play alternative asset sponsor and syndication platform, providing direct real estate access opportunities at the asset level. And all that really means in layman's terms is that we syndicate capital to family offices, accredited individuals, boutique wealth management firms on a deal by deal basis. To date, we have acquisitions in 12 markets, a gross portfolio value at over $350 million, and we run over 2.5 million square feet of commercial office space spread primarily throughout the Midwest and Southeast. We very deliberately stay away from traditional high rent, high tax, high cost of living kind of gateway MSAs. Instead, we've been targeting secondary and suburban growth markets that we've attached a high quality of life to. And our investment premise is really straightforward. It comes down to three things. One, above all else, we're focused on capital preservation with access to real assets. Two, we're very much cash on cash yield intensive. We're trying to solve for that kind of 7 to 10% cash on cash yield, which we distribute to our investors on a monthly or quarterly basis. And 3, for our taxable investors, which probably doesn't apply as much to this group, we do a lot to maximize the tax benefit, tax treatment to our limited partners that comes from direct real estate co-investment. So with that, I'll put myself on pause and hand the floor back over to Larissa.
Okay. Thank you for that introduction, Jonathan. So we're going to move on now, and really, sort of what we're here for and what everybody would like you to share some insight on is what you're seeing as far as the trends, how that sort of has affected how you guys choose your investments into commercial real estate. And of course, the pandemic plays a big role in that. But when you and I discussed it, you mentioned a few times that even before the pandemic, the millennial demographic has been sort of making changes to their lifestyle. And that has really sort of been the deciding factor on how you guys invest and where you invest. So let's talk about the trends. And why don't you tell me and tell the group a little bit about what you're seeing and how that has changed the way you guys make investments.
Absolutely. And I think that's the object of the conversation, to kind of talk about millennial demographic shifts, patterns, and how COVID is impacting all of that. And it's a little bit cliched, but I think it's accurate that COVID is acting as an accelerant to kind of pre-existing trends and conditions. What we saw pre-COVID was increasingly millennials, and a lot of this was because of 2008, they had delayed their typical kind of family formation phase, roughly about 5 years or so. There was this kind of narrative on Wall Street that this millennial working generation, which is now the largest cohort in America, it's around 75 million people total, was always going to kind of live in Brooklyn, wear skinny jeans, eat avocado toast, never have children, live in an apartment forever. And that was kind of the image that we were all sold. But the reality is that they delayed the family formation process. It is happening, it's just happening later in life. They are getting married, they are having children. They're increasingly making choices about where they want to live, work, and play based on the quality of life, cost of living, access to single family homes. And that doesn't even mean purchasing, it just means the ability to own or rent, which I think is an important distinction. And really kind of access to quality primary education, public education options for their children. Increasingly, because of COVID, millennials actually just want more space in general. And I actually think that this is where single family home world and commercial real estate world really paralleled one another. It's kind of increasingly this millennial generation, because of COVID, just needs more space. They want to get away from that density and that really urban environment, and they're looking towards the suburbs and secondary markets. These just kind of really check a lot of boxes. And for many of us, I feel like every generation kind of goes through this. Our parents, my parents, the hippie generation, just kind of pushed back against their parents' lifestyles, and they said they would never live that way. And I know as a millennial myself, I barely qualify, but I do. Back in the 2000s, we were kind of never going to live in the suburbs, drive an SUV, send our kids to the same schools. But, like most generations in the past, we yearn for that same type of upbringing we have for our children. So yeah, I think our thesis has really been that over the last 5 years, the kind of census data shows that there has been this kind of population redistribution from the New York cities, the Chicagos, the Los Angeles, the San Franciscos, to some of these kind of secondary up and coming growth markets, Austin, Nashville. We're very bullish on places like Richmond, Virginia, Raleigh, Durham, Kansas City, places that we think are going to, continue to see not just increased population growth, but we think that a lot of these jobs are actually going to follow. So we think the redistribution is real, it has been real, and we do think that it actually accelerates in a post-COVID environment, if there is such a thing.
Gotcha. Okay. Yeah, and you mentioned that when do you feel like you started seeing the trend and start making decisions on investing based around the trend changing? Because if it was let's say, I think you mentioned 5 years, what have you changed from then until now, and what will continue to change as far as, is it location? Is it the types of commercial assets? And I know we're going to talk about the types in just a minute, but what changes have you made when you're making those investments?
You know what? That's a great question. The census data shows that this has really been kind of the situation since 2015. From the late 90s to the mid 2000s, the urban metro just kind of continued to grow. Everybody, I think the kind of the profile, the headline or kind of talking narrative now is everybody's, if there's this mass exodus out of these same cities. But what we're saying is the data shows it's actually been happening the last 5 years. It might be kind of happening with more velocity now at a larger scale, but this is just kind of exacerbating an existing trend. Tell you what's changed in the last 5 years. 5 years ago, we could actually buy a property in our backyard here in Nashville. At this point, we're just priced out. There's too many of the bigger shops in New York, LA, really looking to kind of invest and deploy their resources into the Austins and the Nashvilles of the world. That leaves us kind of more focused on places like Des Moines, Iowa, Omaha, Nebraska. We own in Cincinnati. We own in Columbus, Ohio. We own in we own multiple. We just closed our 4th acquisition, in Kansas City. These are kind of flyover locations to some, but we really think that the growth potential in these markets is going to far outpace some of the more high profile secondary markets like we're in Nashville. We feel pretty well positioned throughout our overall portfolio that we are targeting and own in these secondary markets that all kind of have real kind of increased growth projections attached to them. I think if you're a commercial office owner right now in New York City, you're pretty freaked out. Being a commercial office owner in Raleigh, Durham, North Carolina, you feel like a lot of that New York workforce is actually going to end up in your market. So you feel pretty kind of resilient, especially due to the nature of our business, which is, really kind of predicated on longer term leases. We feel pretty well positioned to not only withstand this, this COVID downturn, but we expect to actually thrive on the other side of this, just based on kind of how we are really kind of doing our searches and targeting the markets that we do.
So it's not necessarily not buying in cities, but it's more buying in the right type of cities. You still named some pretty big cities there. I mean, Columbus, Ohio. So it's not necessarily just buying maybe in the suburbs, but just not buying in cities where those investments might be more expensive or I don't want to say highly sought after because it sounds like the markets you're buying in are highly sought after, but tell me a little bit about that trend, because it's not necessarily not buying in big cities, but it sounds like you maybe have a formula.
Yeah, I mean, I think what we're going to start seeing increasingly is that there's going to be more of, a real kind of tax pressure that causes a lot of, after COVID, I think it's going to be downward tax pressure that forces more individuals and companies, corporations out of certain states. I mean, the reality is it's not just kind of people looking to de-densify, although that's part of it. They're also looking for, cheaper rent and less tax. And places like New York and Chicago and Los Angeles that look like they're going to have to increase their taxes while at the same time cutting a lot of their services and programs, that's going to force a max exodus of the tax base, and that's Democrat or Republican. It's completely apolitical. I think increasingly the reason that landlocked states like Texas and Tennessee make so much sense for so many kind of new residents is the fact that they're very tax-friendly states. And I don't think that's part of the story that's really been addressed yet, but I have a feeling that conversation really kind of has a place at the table in the coming years.
And so it's, not just talking now about, the areas that you buy in, but tell us a little bit about how your decisions for the types of investments that you make are based around these new trends, and why do you feel like these specific types of assets are good for the trends that you're seeing?
Yeah, so, the majority of our portfolio, which is at over 350 million today, is comprised of multi-tenant commercial office spaces spread throughout the Midwest and Southeast. We typically are pretty conservative in our underwriting. These are illiquid long-term holds. We're really looking at buildings with credit quality tenants, longer term weighted average lease terms of at least 5 years. And then it's important to us to see at least kind of 90% occupancy in the building when we're buying it. Due to that kind of, and then our return, on investment really comes from cash on cash yield, which we distribute through quarterly and on some deals and monthly basis on others, depending on the deal, to our investors. So we're not as much back end IRR capital appreciation driven. Our investor base today really is kind of looking for that solid quality stabilized yield, with a regular kind of return throughout the year.
So tell me, when you look at something like a storage facility, basically, are you looking at how do you come to the conclusion that this area, this storage facility, is the one that's going to be a good investment? Are you looking at the population, or what kind of demographics do you use to make that decision? And again, you mentioned some larger cities. Is this the type of investment you're making in larger cities? Are you looking at more suburban areas? What sort of drives that type of investment?
Yeah, storage facilities are interesting. I mean, I think, the appeal of storage facilities, there's a lot of appeal, but right now at a time when hotels, travel, retail, and restaurants are all hemorrhaging, it makes sense that self-storage facilities would continue to see demand as both consumers and businesses are more likely to downsize during a downturn. There's 4 Ds that we kind of stick to: downsizing, divorce, dislocation, and death. All are aspects of real life. And the reality is that recessions tend to exacerbate these life events, leading to increased rental activity in the self-storage space. And as both kind of companies and consumers downsize, you've got to expect storage will continue to see demand.
So tell me then about medical office buildings. Are you seeing an increased demand on this, or has it sort of been steady, or has it changed? What do you see sort of for the future of that type of investment?
Yeah, that's where we've been most active on our last couple of deals, is on the medical office building front. I mean, if there's anything more essential than kind of, medical workers, hospitals, if that hasn't kind of, made itself very clear during this downturn, then we're going to just be at an impasse. But all the demographics are just wildly behind this. If anything, the medical office building space has gotten exponentially more competitive during COVID, and the prices have gone up. This is a place where, other syndicators and sponsors like ourselves really, really want to play due to kind of the stabilized nature of the medical office building. And, some of the demographics that really support this: 10,000 baby boomers enter retirement every day. Most of them have very little savings. To me, this indicates that the demand for healthcare services outside of kind of a traditional hospital setting is not going to go away. I think that it's actually set to increase as baby boomers, and that we define those as those born between 1946 and 1964 enter their golden years. You know, their medical needs and demands are sure to only increase. This demographic, like the millennials, is also 75 million strong. And, you know, as I said, their need for medical attention is only going to increase as they age. Seniors tend to spend about 5 times more on medical services than those in the younger generation, which would be Generation X, I suppose, right below that. Because of this influx of patient needs, there's going to be a need for more medical offices, more outpatient clinics, and more surgery centers that might be affiliated with the hospital but not connected. That's really how we see that space. And we think it's got, if you're looking for like a stabilized type of office play, that's where we're seeing a lot of appetite and interest right now on the medical office front. It's just a space that's gotten wildly more competitive.
Okay. And then how about suburban multi-tenant offices? Tell us about that. And I think there's a lot of interest in that, especially right now, because we're trying to understand where that type of investment is going to end up. And so what strategies do you employ, and do you sort of see what sort of trends do you see for this type of investment? And, you know, I network locally with commercial realtors. And so I know at first it was sort of, you know, everybody was sort of moving around just to see what was going to happen, where we were going to go with it. But I do see that the demand is still there. But maybe you could tell us how it's changed over the last 8 months.
Yeah, this certainly isn't in line with historical trends. I mean, right now, commercial office is not a conversation that people are particularly excited to have. But, you know, I'd like to introduce the idea that multi-tenant offices located in suburban growth markets deserve a place at the table now. The belief being that kind of secondary and suburban markets will continue to see increased population and job growth post-pandemic. And generally speaking, cash flow is always king in real estate investing. But during a recession, which we're still not completely out of the woods on, cash flow becomes exceedingly valuable. The more income you have, the better positioned you are to kind of cover your expenses and debt service. Even if a significant portion of your income investment is suspended. Income-oriented, multi-tenant office space, especially when anchored with credit quality long-term tenants, a weighted average lease term of at least 5 years, really has the makings of a very, very resilient asset in the midst of any type of downturn. The fact that real estate has historically been a hedge against inflation, I think is particularly attractive, as that's still on the forefront of investors' minds, even though we've entered this period of intermediate and artificially low interest rates. You know, I think that investors are really trying to kind of assess the impact of a slowdown in demand caused by industries that intend to lean into work from home. I think that shakes out. Some people work from home permanently, others a day or two a week rather, versus what we believe to be the long-term densification trend that has packed more employees into less space. If there's anything we do know at this point, it's that the WeWork model, which had kind of sardined workers down to about 75 square feet per body, when the national average was about 214 square feet per person. You know, that kind of model has been obliterated. It's not going to work in a post-pandemic world. Not to say that co-working is dead. I don't think that's the case, but just packing as many people into a small space is just no longer an option. I think that, you know, investors were probably thinking initially in the pandemic, and when I say initially, I mean March, April, possibly into May, that work from home looked like kind of a viable solution. Productivity was up. People seemed to be getting it done. But I think what the data is showing us at this point, some 8 months later, is that people were kind of motivated by fear of losing their job, just greater uncertainty, and that it was just kind of a burst of productivity, but it was fleeting. It hasn't withheld. And I just don't believe yet that a decentralized work office can really kind of work. I think the irony is that you hear about certain industries that are more likely to go work from home, particularly the industry, the technology industry, Silicon Valley, but the biggest buyers of commercial office space this year have been Google and Facebook. These tech companies are only increasing their office footprint. They're not downsizing. So it's kind of a false narrative that's happening there. And I just think it's really interesting to watch it unfold.
So you mentioned having a good, solid, long-term tenant for multi-tenant office. And so you don't have to give us a company name, but can you give us sort of an example of an industry that would be a good long-term tenant? So you mentioned tech. Is it tech? Is it, medical coding? Is it, attorneys? And can you give us an example of what you would consider a good long-term tenant?
Yeah, I think it's, anybody that really is kind of into, data storage right now. I think that's a great place to be. I think that cold storage is an interesting place to be. I think on the tech side, you're still going to have more people going into the offices. I think actually and this is just my anecdotal opinion, but I think where you're going to start to see a real decentralization is with law firms, attorneys, and kind of wealth management advisors. I think that what we're really experiencing there is that, for attorneys, they can still kind of bill from home. I think billable hours have been one kind of consistent thing that have experienced uptick for lawyers during the pandemic. I think a lot of wealth management guys are just thinking, why do I, especially on the private RIA side, they're thinking, why do I need to pay for office space when, I can either meet my clients in person, places that they're choosing, or just kind of go more virtual with our meetings. And I think that's where it kind of makes more sense and is appropriate. Medical office, obviously, I think is going to continue to high fly. And then just, I think that there is some big infrastructure dollars coming through some round of stimulus. When that is, I don't know. I think that, if you're in any type of building or manufacturing, I think that you're kind of in a safe place right now as a big time operator or corporate user.
Great, thank you for that. The last one here on your list was mobile home parks, and I myself see a giant trend in mobile home parks. A lot of people are syndicating for mobile home parks, and there is a lot in the circles of in the networking circles that I attend, where people are talking about mobile home parks, and there's a lot of interest there. And of course, the idea behind that being that it is inexpensive for people to live, and a lot of them offer, a great community, a great sort of sense of community and neighbors. And so we're definitely seeing a big interest in those. Can you tell us a little bit about that?
Yeah, absolutely. I mean, there's always been, for so many investors, I think that there is a real kind of emotional stigma attached to mobile home parks. But to your point, I mean, these, especially recently, have become the darling of all commercial real estate. That's a pretty big label, especially considering investors really were looking down their nose at this asset class a few years ago. But it's real. I mean, they're recession resistant. They're steady in all cycles. There's a limited supply, which makes it a unique asset class. There is an affordable housing crisis that's potentially kind of getting more disproportionate, and that equates to increased demand. There's historically high switching costs with mobile home residents, which equates to kind of lower tenant turnover. And, there's a lot of fragmentation. You can be a mom and pop owner and launch your own mobile home park. This isn't something that's kind of being overtaken yet by the private equity institutional elite. Low operating costs, low maintenance and capital expenses, and then there's just less competition, or at least there has been, due to, once again, that stigma of manufactured housing. I think that for the savvy, income-oriented commercial real estate investor, you got the smartest guys in the room right now that are completely focused and fixated on mobile home parks.
I even see a big uptick in the number of individual mobile homes that, yes, they're in parks, but they own the dirt basically underneath them. And I'm seeing a big uptick in people that are rehabbing the mobile home. So, going in there and bringing it up to where somebody would either want to, it's competitive to rent it out, or to sell it to an end user. So I'm seeing a lot of that even on the individual basis. And I think that's an interesting trend that probably a lot of people are seeing for mobile homes.
Yeah, I mean, the reality is that it's the most affordable form of housing in the United States, and there's this like NIMBY, not in my backyardism, basically makes it difficult to obtain, and because of that, there's not as much of the supply as there should be. It's a very attractive asset class to be in right now.
Thank you for that insight, Jonathan. And I know we talked about this a little bit. And of course, if you're on with us today, you know that it is the day after election day, and there is, of course, a lot of uncertainty right now. And we're going to really just touch on that with Jonathan because we don't necessarily have an opinion to share with you as far as the outcome of the election. But with every election year, and of course, especially now with the pandemic, there's a lot of uncertainty, and that has an effect on commercial real estate. So, which direction? How do you feel like it has impacted commercial real estate so far? And can you give us just your opinion on what we'll see as we end the year here?
Yeah, I don't think it really has affected commercial real estate. I don't think the market really cares one way or the other, whether it's Trump or Biden, honestly. What the market wants to know is that there is a decided winner. I mean, there's an old kind of Wall Street saying, the market can handle good news, the market can handle bad news. What the market cannot handle is uncertainty. And I think that the most dangerous period is this, what appears to be this uncertain period we're entering right now, where there's going to be indecision about who won the election. Both sides are going to kind of like dig into their team, and this is probably something that gets kicked up through the courts, and we maybe don't have a decision for a month plus. I think that's kind of the scariest period, but when that does settle and ultimately we will have a winner that's accepted, I think the market's going to kind of just release that anxiety and level out. We've been living in this kind of period of political uncertainty for most of 2020. And I think the reality is that we're going to have this kind of period where maybe the worst is yet to come. Although I think that, this TBD, to be determined mode is only going to be temporary, and everything is going to work out. I think what was kind of most concerning to real estate investors under a possible Biden administration was the changes proposed to 1031 exchanges, which essentially allows a real estate investor to transfer the investment and proceeds from one real estate opportunity into another on a tax deferred basis. So it's a really powerful tool. I think that, Biden was really, really looking at reducing the amount that can be kind of transferred tax deferred, which would theoretically kind of create this real boon to utilize these 1031s before they kind of became obsolete. But I'm thinking the reality at this point, if Biden is to become president, that not a lot's going to happen on the tax front. We're going to have what it looks like, where there is some clarity, is that we're going to have a Republican majority in the Senate. And I think it's just going to be kind of a cautionary 4 years where there isn't much tax reform and not a lot gets done. I think that we would just kind of enter this period of gridlock. But I don't think that there's going to be a lot of regulation or reform on the existing tax rules as long as there is a Republican Senate and majority.
Well, and I think to your point that it'll just almost be like a collective sigh of relief to have 2020 behind us. You know, I know that I cannot be the only one looking very hopefully towards 2021, and you know, being able to get back out there and not have to worry about the pandemic. And I don't know when that will be, and I don't think anybody does, but I think that we're all sort of hopeful for 2021 and being able to move forward. So, and I think that that has, you know, impacted in a way almost everything that we do in everyday life. So I'll be happy to have that behind us for sure. And I think with the election behind us, we'll all sort of breathe a sigh of relief regardless of who becomes president. So I'm going to make a couple of quick announcements. I think we answered all the questions, but I would like to encourage everybody for these last minutes here that if you do have any questions, to make sure and type them into the chat box so that we can ask Jonathan your questions and get them answered. I also wanted to let everybody know that the slides are a handout loaded right now under handouts. So if you wanted to download the slides so that you can keep them for your notes, you are welcome to do so. They are loaded as a PDF. You have access to them now. So again, just in the last few minutes here, you have the opportunity to download those if you would like to. I want to mention again that you have access to our Learning Center at all times through AdvantaIRA.com, and any webinars that we have done in the past are recorded and saved there, as well as to our YouTube channel, and you'll be able to find this recording as well. I also want to mention that our networking event is coming up. It is on Friday, so if you guys haven't joined us for a networking event in the past, it is on Zoom. People do join us nationwide, and everybody has the opportunity to introduce themselves and speak. You have the opportunity to talk about what you're looking for, what you're doing, and give us an idea of what your market looks like. We'd love to have you on. So if you guys are interested in that, just check out AdvantaIRA.com and /events, and you'll find that information there. I also want to mention that you guys are welcome to reach out to me or Jonathan with any questions. And again, his contact information was on one of the slides, and I'll have him repeat it for you just before we end the session here. Thank you again, everybody, for joining us. I don't see any additional questions, so I just want to thank Jonathan for joining us. And Jonathan, if you would, please go ahead and share your website. And actually, you know what I'll do is I'll scroll back up to Jonathan's slide. So here's my contact information. You guys are welcome to reach out to me. Again, I thank you for joining us. And here again is Jonathan's information as well. Thank you so much, Jonathan.
Thank you very much for hosting us. We really appreciate this. Is a wonderful collaboration. If anybody has any questions or would like to follow up, I encourage you to just reach out to me, email or phone call, check out our website. I would love to be a resource.
All right, great. Thank you. Thank you so much, everybody. And we will have another event coming up soon. Again, our networking event is Friday. I hope you'll join us for that.
Thank you, Larissa.
Thank you.